Alright, so this is going to be a quick video. I just want to talk about how I made 18% in 2 weeks with this stock here. Now I admit I got lucky, but I took the risk to begin with. So if you've watched my previous videos, you know that my strategy right now is writing covered calls. So I basically picked this stock just because of its high premiums, high call option value. So I bought the stock on March 18. I bought it at 8.25 and immediately sold call options at a $7.50 strike price for $2.10. I bought 400 shares of this stock, so therefore sold 4 call options. So when I bought the stock at 8.25, I immediately collected $2.10. So my true cost basis is $6.15. And the strike price that I chose these call options at was $7.50. So come April 18, which was my expiry date, if the stock is trading above $7.50, then my shares would get called away at $7.50. But that's the plan. Since my cost is $6.15, I'd be making a good profit. But then when I bought the stock at $8.25, it dropped all the way down to $7.13. So in my mind, this was another bad pharmaceutical trade. I already had 2 very bad pharmaceutical trade. One is down 70%, the other is down 50%. But I still went with this because the numbers looked really good. Yahoo Finance gives it a 29 target price and a 1.4 strong buy recommendation. So I got tempted again, and to protect myself, I picked a strike price that's lower than the market price when I bought it to give myself downside protection. So the stock was trading at 8.25 when I bought it, but my cost right away was $6.15 because I sold call options, so I'm protected by that much. But then it started dropping, went to $7.13. So even at $7.13, I'm still profitable. But then for some reason, the stock jumped all the way up to 10.75. Now, obviously, I can't take advantage of that increase since I have a strike price of $7.50. So the maximum that I could make is $7.50 minus $6.15. But all I want is for the stock to stay above $7.50 come expiry date. I don't want it to drop below $6.15 or else I'd be losing money. So as long as it's above $7.50, I'm happy. So when I see it at $10, then I'm very happy because it's more assurance or more confirmation that come expiry date, it'll be above $7.50. But then right after it starts dropping to 9 and dropping pretty quickly, 8.65, and then today you could see it at 8.60. So what I did is I tried to get out of the position by buying back the call option and selling the shares immediately, and I was able to do that at $7.30 because I wasn't sure what was going to happen come April 18. I was afraid that the stock would react and just drop more come April 18. So I saw an opportunity to get out early, actually 3 weeks earlier, and I still was able to make 18%. So I was able to get out at 7.3. So 7.3 divided by 6.15 is 18%. So I made 18% from the stock in 2 weeks. So if we annualize it, that's 468% in a year. But of course, not everything is going to be 18% in 2 weeks. I'm not going to make it all the time. But just to visualize what 18% in 2 weeks is, it's 468% in a year. Now, not every covered call strategy is going to give you 18% in 2 weeks. Of course, on average, if you pick the right stock, you should be able to get 3% per month, which I believe is what I'm averaging with my other stocks. Some more, some a little bit less. But just wanted to share this trade here because I'm glad that I was able to get out of it earlier than expected and still come out 18% on top. But I'm definitely not going to do this again. I'm not going to go for pharmaceutical companies again because I just can't handle the fluctuations. I got lucky this time. I think I've bought 5 or 6 pharmaceutical stocks, risky ones, and 3 or 4 of them have been very positive, very profitable, but 2 of them have burnt me, down 70% and down 50%. So although stat-wise I'm doing well, but I know I could get burnt very easily. So and I can't handle that stress, so I'm not going to do pharmaceutical companies anymore. But it's just great to see that the strategy really is beautiful. And with 400 shares, I made a profit of about 450, I believe. So 7.3 minus 6.15 times 400. So 460 US. So about 600 Canadian in 2 weeks. Although I'm proud of this trade, but can't be too proud because it's not something that I'm going to continue. But like I said, just wanted to share it with you. And what else is great is that I found a way to save more fees with Questrade by placing the order in one trade. So for example, ALDX, if I look up ALDX here, if I want to place a covered call trade, instead of buying the stock and then selling the option in two separate trades, I could do it in one single trade by clicking on covered call here under call puts. Click on covered call, and then by choosing the strike price that I want and the expiry date that I want, and then placing the order entry here, send order, and I save in commission. As you can see here, $5.70 instead of $5 for buying the shares, $5 for selling the option. So by placing it in one trade, I got to save on commissions. And also by not letting my shares get called away, by buying back the option myself and selling the shares immediately, I save the $25 fee for option assignment that Questrade charges. So if I look quickly on my covered call trades, I mean, American Airlines, I did it last month. So if it stays above 32 come expiry date, right now I think it's trading at 33, probably make 5 or 6% on that trade. AMD, I'll probably make 4 or 5% as well. Activision, probably make 4%. Bristol Myers, right now it's trading at 47, so if it's still trading at 47 come expiry date, I'll keep the shares, but then my next call option will be very low. So let's look at it right now. If I wanted to sell May 17 call options on BMY, I would not choose a 47 strike price because my cost was 50. So I would choose a 50 strike price, and you can see it's trading at 56 cents. So that would give me 1%. So you could see that for the following month, depending on the price of Bristol Myers, I'd be making much less than 3%. In this case, I'd be making 1%. So I've got cars.com. This one looks like it's going to be positive. I think it's going to generate about 7% here. Let me just calculate it quickly. So I chose a 22.5 strike price, bought the stock at 22.81. So minus $1.56 is what I collected. 21.25 is my cost. My strike price is 22.5. So $1.25 divided by 21.25. Yeah, so 5 to 6% if the stock stays above 22.5 come April 18. Kraft Heinz is pretty weak. Macy's will probably generate me 2 or 3%. Print depends what Sprint will probably generate me 8%. Here, let's see what it's giving me right now. So I bought the stock of 5.51, collected 41 cents. So that gives me a cost of 5.1, but my strike price is 5.5. So the most I can make is selling it at 5.5. So that's 40 cents on 5.1. So 0.4 divided by 5.1. So that's 7% as well. Yeah, Six Flags is going to be weak as well. Anyways, this one expires May 17. Twitter is going to get called away. So this is the second month that I sold call options against it. So this month I collected $1.42, but I'm also going to collect an extra 50 cents come April 18 because the strike price I chose was 31. So collected $1.92 on $30. So I collected $1.92 on 30.5 investments. So 192 divided by 30.50. So that would be 6% this month. So although these percentages might not seem high, but what's great about them is their consistency. That's the idea of the strategy, is make small consistent gains month after month instead of waiting for those big gains that might come or might never come. And those small gains that you're making every month, you get it right away to use towards something else and buy something else or invest it. So that's really the true effect of compounding. Weight Watchers expires May 17. It's not getting much out of it, so this was a bad trade as well. And United States Steel, looks like I'm going to end up keeping my shares. My cost is 21.8. So this month I was able to sell for 25 cents, so about 1%. And I think next month will also, depending on what the stock is trading at, might be the same thing. So it's not always 3%, but sometimes it's 6, sometimes it's 3, sometimes it's 1. But on average, it's around 3%. CHK is going to be a good one. I think it's going to be almost 12%. IMGN is a terrible one. Micron is going to be a good one as well. Well, my profit is already capped because I picked a strike price that's in the money. So I bought the stock at 39.75, but I sold at a 39 strike price because I thought the stock would drop, and it did actually drop, but it went back up. So my profit on Micron, which is already known, the max I can make on Micron is 39.75 minus 2.68 minus the 39. So 193 is my max on a 3707 investment. Yeah, so 5%. Not bad, of course. And Teva is going to be a bad one. ACBs, I'm going to end up keeping my shares, but it was a good trade. The stock's not trading far from my cost, plus the premiums are pretty high. LB is going to get called away. Trading at looks like it's going to get called away, but it was also a good one, about 4%. So yeah, if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. And it is tax season, so if you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. Thanks for watching.